Welcome, Charles. Thanks a lot for coming on the Tech Guys Who Invest podcast. We're really excited to have you here with us today.
It's a pleasure to be here, guys.
So, Charles, you are a CPA, and we know you work with real estate investors. And we'd like to start out by just kind of asking you why an investor might want an investor-friendly CPA to be part of their team.
It's a really good question. I met with a client earlier today that did not have an investor CPA do their taxes, and there were several deductions that were missed. You could look at the return and you could see that one of the properties didn't have insurance listed on there. Now, if you're an investor, you know most rental properties that you have mortgage interest, property taxes, insurance, auto expense, because we know we're driving to our rentals to do these repairs, right? We should also be able to see that repairs are kind of in line, not out of the norm. For example, you give me a rental property on a single family residence that has $5,000 in repairs. I know that you did some kind of rehab project. I know that we have to capitalize and think about depreciation, whereas an enrolled agent or a CPA that isn't familiar with real estate may not catch those things. One of the things when I prepare returns, I'm always looking at the red flags. Why do we have $5,000 on repairs on a single family residence? That tells the IRS, hey, there's probably something capitalizable in here. We're writing off things we shouldn't be able to write off in the current year. So I'd want to talk to the client about that and see if we can pull that red flag off, change it, depreciate it, move it to a different category if that's appropriate. And a CPA that isn't familiar with real estate isn't familiar with thinking along those lines.
Okay, so if I understand correctly, because you work with investors, you understand how the business works, you understand what their expenses should be, and like you said, you're looking for any red flags. Did we get that correctly?
Exactly right. To find out what expenses look out of line and what expenses are missing.
So with those two things, what expenses are out of line and what expenses are missing, are there any other disadvantages that you can think of for somebody that's trying to save money and say, I'm going to do TurboTax, something along those lines?
Oh, yeah. TurboTax is a nightmare. Have you ever used TurboTax?
I did before I met you.
There we go. I think the worst case I've seen was a lady who deducted her car 3 times. And when I looked over the return, it was on Schedule A, Schedule C, and Schedule E. And when we looked over and I asked her, why did she deduct her auto 3 times? Well, TurboTax asked me 3 times, so I kept saying, yeah, I have a car. Here's my mileage. So triple deducting mileage. But aside from that, when you're working with a CPA, you guys are familiar, since you guys are investors in real estate, about the passive loss rules and possible ways to get around that. Like, we have the real estate professional status and other things in the law that when you go through a TurboTax product, you have to go through this huge questionnaire where it asks about every possibility. You make one wrong choice, and now you're going down a rabbit hole that you shouldn't be going down. So if you're talking to a CPA, who knows the issues, right? Who's familiar with the issues, they can guide you a lot more efficiently and lower that tax bill. Because there's a lot of things we can do when we think about it. And just using a program, there's no thinking going on.
So one of the reasons that a lot of people invest in real estate is because there are tax advantages. And I was wondering if there are some of the top tax advantages that you think of when your clients are maybe consulting with you about, hey, should I invest in real estate? Or maybe they're talking to you about, hey, Charles, I'm thinking about investing in real estate. What are some of the top advantages that you think come with investing in real estate from a tax perspective?
Well, before we get into tax perspective, I think that having somebody in your house paying your mortgage for you for 30 years and then handing you a free and clear house is one of the fastest ways to wealth. I think it's fantastic. Excellent. I shouldn't say fastest. I think most efficient, right? But the tax advantages, and it's really funny that you mentioned that, because a lot of people are talking about investing in their IRA, which can be a good strategy, but it isn't for everyone. Mm-hmm. The thing I like about real estate, if you buy it right and you rent it appropriately and you don't rent it to a bunch of people who are going to destroy it, you have a nice cash flow. The beauty is that with depreciation deductions, which I can either accelerate or slow down depending on your situation, we can have a negative tax effect Or at worst, let's just say that you make a couple $100,000 a year and you can't take your rental losses because of the passive loss rules. At least we have this $200, $300, $400 per property rolling in, and we're not paying a dime of tax on it. That I love.
Well, that's fantastic that we're talking about the things that you can really deduct, those expenses and depreciation. I wanted to take a step back, and for our listeners who don't quite know what passive loss rules are, could you explain that a little bit more?
Absolutely. Back in pre-1986, there were a bunch of doctors and lawyers that were basically gaming the system and deducting everything under the sun. They'd invest in rentals and family limited partnerships and publicly traded partnerships and deduct like crazy, totally wiping out their medical practice income. Well, in response to that, the IRS changed the law. And one of the things they added was the passive loss rules. And here's what they basically say. The passive loss rules say that you cannot deduct passive losses. So we have passive income and passive losses. They can offset to the extent that we go negative. That net passive loss, not deductible at all. Basic rule. Then they carved in an exception for real estate investors like us. They said, we know what we just said about passive losses. However, if your income is less than $100,000, we'll let you take up to 25 grand of those losses against your other income. Very nice benefit. If you're between $100,000 and $150,000 of adjusted gross income, we're going to whittle that down until once you've passed 150, you can't deduct your rental losses anymore. So that's basically how it works. When you have high income individuals, that's where they really get caught up in that. So what happens to those losses? They attach to the property, and when you sell that property, they'll instantly be freed up to take against your other income. Or if you ever have a rental down the road where it's free and clear and it's producing a positive income, those losses will offset that positive income, making it tax-free for a period of time.
Yeah, that's really interesting. I think one thing about taxes is, to your average person, it's really confusing. I think to most people, it's pretty confusing, and they don't understand a lot of what they can do to lessen their tax burden, or some ways that they can make taxes their friend rather than their enemy. And I know that's what you help a lot of people with, is strategies or things they can do to really increase the advantages that they may be able to take. What are some things an average W-2 worker can do to minimize their tax burden?
Well, with the change in the tax law and the increasing of the standard deduction, it's difficult. So we talked about where if your income was less than $100,000, we can take rental losses. So that W-2 employee could go out and start investing some of his surplus cash, get the HELOC on the house, put it on a down payment on a rental, and get a string of rentals that starts producing losses. He can use that to offset his W-2 income if he's below 100 grand of income. You know that we've used buying your own personal residence as a tax deduction for a very long time. With married filing joint, standard deduction of $24,000 now, that's ceasing to be a strategy. So aside from rentals, the next best thing they can do is fully fund their 401k. That comes right off the top. So if you can put away 18 grand or 19 grand into your 401k, it's not going to be taxed. That saves them a lot of money. So those two things would probably be the best thing for a W-2. Once you become self-employed, it opens the door to a whole bunch of deductions that we can take. We can absolutely talk about that if you want to.
Yeah, that might be fun to dive into.
Absolutely.
Podcast.
Now,
everybody buckle in.
Before we do, I have a quick question about the 401k. So fully funding the 401k can be something to do. And would that include self-directed 401ks?
Well, if you're dealing with a W-2 employee, chances are they're stuck with their employer's 401k plan. So they really don't have a choice. If you own your own business, one of the best deductions we can do is put in a SEP or a simple or some other, like a solo K, where you can put away tens of thousands of dollars per year. And then, You play the game of where you hire your kids and you pay them a minimum wage, like a $6,000 or $12,000 wage, and you fund their retirement as well. And then you can bring the wife onto payroll and pay her, a nice little 401k contribution. So there are ways that we can save large amounts of money. But your original question was about a W-2 employee, and that's really limited. Business owners, it opens the door quite a bit.
So when you say self-employed, I guess that implies business owner. One thing I wanted to ask and clarify, when you talk about rentals, there's the implication that you own the property that you're renting it out. So my question is catered towards, like, let's say you do master leases or lease option or something where you're using Airbnbs, like you rent it out and you use Airbnb. Does that still constitute as a rental, or is that completely different?
Yeah, there's some, it's still a rental. But a lot of times, short-term rentals can be moved into, like, less than 7-day rentals can be considered ordinary income. They move over to Schedule C. I don't like that result because Schedule C, like any other business, is subject to self-employment tax. So I much prefer the long-term rentals where the rental period is more than 7 days. Look at it this way. Let's say we had a hotel. That's not a rental because our average period of rental is less than 7 days. So that's just an operating business. Plus, with a hotel, there are definitely considerable services being provided, which takes it out of the rental bucket and throws it into the business income bucket. So it can get a little bit tricky right around the Airbnb. That's a really good question.
So a couple of things you mentioned are like the SEP or simple or solo K for people who may not be working a W-2, but own their own business. It sounds like there are a lot of opportunities for people to get really creative if they own their own business. What are some things you see that are maybe not super sophisticated, but kind of common for people like that? What they like to do using those products?
You mean what do they invest in, or?
Yeah. Do you see a lot of people use those products to invest in real estate? And then are there some tax associated advantages with doing that?
That's an interesting area. I don't usually, when you're a W-2 employee, you invest in their stocks.
Right.
For somebody who owns their own business, to invest in real estate, you and I talked about the tax advantages that we have. The positive cash flow with depreciation, a negative tax effect. If we put that in an IRA or a retirement account, we tend to lose some of that benefit.
Right.
I really like investing in real estate in a Roth IRA. Because when that property appreciates, we're never going to pay any tax on that appreciation. But let's consider just ordinary rental real estate in a traditional IRA. If we held that property for 10 years, we wouldn't pay any tax on it until we pull that money out of our IRA, right?
Right.
It's pretty good. It's not no tax, it's tax deferred. It also changes the character. When you pull money out of your IRA, it's ordinary income subject to ordinary income tax rates. If we had held that rental personally instead of in that IRA, and we sold it after 10 years, you're familiar, there's a capital gain rate that we can party on. So we've actually lost the ability to take capital gains by holding real estate in our IRA. So it does have some distinct disadvantages. What's the best advantage? I love the Roth. We're never going to pay tax on any of the earnings, any of the appreciation. It's all tax free, not deferred, but free. That I like. But how do people get that money into their Roth IRA?
Yeah, see, this in my mind is why you have to have a really good CPA like Charles, because average people don't know this stuff. I mean, this is where CPAs just more than pay for themselves.
I would agree. I think with the money I save my clients compared to other preparers, let's just say that you went to H&R Block and it was going to cost you $300. You come to me and it costs you $450. You paid an extra $150. But with us talking about deductions, taking different positions on your return, if I save you $500, it's a no-brainer. But I don't think people believe that actually happens.
I can definitely see where you're coming from, because you're only seeing the immediate, I have to pay Charles $450, where I can see the immediate expense at H&R Block is $300. I'm going to spend $150 more. You won't see that savings until after it's all said and done. So I think that is harder for people to see if they've never experienced it.
Yeah, it is. And it's, Kevin and I talk about the wealth mindset on the show occasionally. And the way wealthy people look at things is a lot different than the way the poor and middle class look at things. And wealthy people look at things like this. They think, a CPA is a valuable part of my team. I mean, it's not an option. I have to have a person like this on my team because they save me so much more than it costs me. Whereas the poor and the middle class think more along the cost of it at the time.
I think you're exactly right.
So with that, how do you recommend somebody go find an investor-friendly CPA? Of course, they could come to you, but I imagine there's only one Charles, right? And if we have every single person go to you, that you just wouldn't have enough time to do anything.
Exactly. So I think that if I were a real estate investor looking for a CPA, I'd want to make sure that CPA is an investor himself. That way he knows some of the things we deal with. Are we making our money on the buy? What are we thinking about? Are we going to buy multifamily because the cash flow is better? Are we buying single family because we like the exit strategy better? That's personally my philosophy. What deductions can I take? If you're dealing with a CPA who's an investor, he's already thought about every single deduction he could possibly take. That's the guy to use. If you go to somebody who says, well, I never have invested anything, find somebody else.
Yeah, that's nice. Charles, what type of investments do you invest in, if you don't mind sharing?
Oh, no, I love it. It's definitely, I definitely have a strategy. So back in 2006, when I started real estate investing, I heard everything that you guys heard and everybody in TB and all these other real estate groups here about the land trust and the LLC and the structure for your rental properties. And I was all excited and gung-ho. And I had my first property under contract. And I was very excited. And I told, I don't have a rich aunt with an IRA. So all of my money for my rentals came from my HELOC on my house for the down payment and then traditional financing for the balance. So when I went to go to the bank and said, well, I'm going to go ahead and close on this land trust. It's 123 Main Street Land Trust. They said, we don't close in land trusts. Oh, okay. Well, then we'll just close in my LLC and we'll call it a day. Okay, we'll redo the paperwork. We'll redo the numbers and get back to you. What do you mean redo the numbers? Oh, if you close in an LLC, it's another quarter point. What? I'm trying to cash flow these dudes. I don't want to pay another quarter point. Okay. Just put it in my personal name and I'll figure it out. So I had several options at that point. I could quit claim it into an LLC or I could do something else. And really what we're talking about when we're structuring is liability protection.
Mm-hmm.
So I made the decision right then and there, since I didn't want to pay an extra quarter point. All of my houses are going to have $300,000 of insurance coverage for the base insurance. And I'm going to do a $2 million umbrella. That covers me liability protection wise. But back to property selection. I still want to minimize my liability. So I don't buy any properties with pools. And I only buy ranch style single family residences. Ranch style because, all you need is some guy drinking a little bit too much Jim Beam that night, falling to the first floor off the second floor because you didn't tighten a screw. Now it's your fault and you're on the hook. So no dual level properties. And a kid drowning in a pool is every landlord's worst nightmare. It's because you didn't put up the pool fence, not because they were doing meth in the kitchen. So, I only buy those type houses. There's one other reason I choose those houses is because if the market changes, something goes bad about the area, there's an element that changes or something occurs, I can doll up the kitchen, I can doll up the bathroom, or I can paint the garage floor, and I can sell that to anyone. If I'm selling a 32-door apartment complex to you or to Kevin or to any other investor, we've all been taught one thing: make your money on the buy. I'd rather sell to an end user who will overpay for their dream home. So That's the only type of property. And I've been told by a lot of real estate investors, oh, you got to go commercial, you got to go multifamily. Cash flow is so much better. I get it. However, I like what I'm doing.
Excellent. Yeah, that's great. Good stuff.
Thank you.
I like that you said you're hearing a bunch of noise from other people, but you are steadfast in your own strategy. And I think that is an important key to highlight. And that comes from your knowledge, that comes from your experience, your research. So just anybody out there, other people are going to talk about what they're doing. It may sound like a shiny object to go pursue, but if you've established a strategy that you genuinely like, you should stick with it. There's no point in just jumping ship.
Agreed.
Yeah. And it's kind of cool to hear what different people go after, especially people who have an expertise in in an industry. Like it's really neat, I think, for our listeners to hear what an experienced CPA with investor experience goes after and why. So I think that was really valuable to hear from you. What advice would you give to someone just starting out in real estate investing? Like, Charles, say one of your clients came to you and said, I'm thinking about just getting started. What might you tell them? Or maybe even if it's not a client of yours yet, but they're talking to you about, hey, I might like to get started and I might like you to be my CPA. What might you tell them?
Well, the first thing I'd ask them is, what are you going to be doing in real estate to make money? Because we know there's so many ways to make money in real estate. We could be a lender. We could be a landlord. We could be a wholesaler, we could be a flipper, we could be a rehabber. There's so many ways to make money. My advice would then branch off based on what they wanted to do. The typical person that I have worked with almost starts out the same way. We're going to wholesale and flip a few houses to get up some money so that we really want to do some long-term holding. It always follows the same pattern. They don't have enough money to buy property and hold it, so they're going to make some money by flipping houses. I don't know where, maybe it's the TV that taught all these people that making money on flipping houses was an easy thing to do. I can honestly tell you it's absolutely not an easy thing. It's not easy money. You work your ass off for that money and, things can go wrong. Some beginner mistakes that we've always seen, and I'm sure you know this, people go in and they over-improve a property. They got to remember, it's a standard of living, not your standard of living. Or they buy too high. I see that happening a lot right now because the market's higher. I'm not buying anything right now. I'm waiting, getting some cash together and amassing until the next downturn. So we're going to ask Kevin in a minute when he thinks the next downturn is going to be. But back to beginner mistakes. They use hard money to fund a flip. And when that flip goes sideways, they're stuck paying this hard money until they get rid of the house. Now, imagine this. You borrow hard money because you're going to make a quick flip. You're going to make a quick bit of cash. And all of a sudden the market turns and you can't get rid of this. Okay, ordinarily, if you have a flip and it turns and you're going to be an accidental landlord, that's fine, but not on hard money. Now you're negative cash flow every month, and that can't go on forever. So those are a few of the beginning things that I see that, a couple mistakes like that, and you're no longer a real estate investor. You say, I hated it, I'm never doing it again. And that's sad because I think it's a real key to, it's a path to wealth for sure.
Yeah, I agree. And real quick for some of our listeners who may not know what hard money is, it's a loan that you can get with a lot more flexible criteria to get the loan and a much higher interest rate. So that's what Charles is talking about. It's a pretty high interest rate loan, and they're usually really short term to allow you to get something done so that you can then either refinance or exit out of it.
You got it.
Now, speaking of what you're seeing in the market, now we're going to have to talk about the market cycle. I have no idea when it's going to happen, but everybody keeps telling me when it happened in 2008, I was a freshman in college, so I didn't really understand it. And now you hear all these really smart people saying the market's going to crash. The market's going to crash. So as a CPA, what would your advice be to investors when the market is the impending doom is going to happen, if you will?
Well, I think that, a lot of people quit their day job to become full-time real estate investors. I feel bad for those people because now they have no day job. They have to continue purchasing property even in this market. So their margins are getting squeezed. They're having to pay too much for the property. They're obviously improving it. And then when they go to sell it, they're not making as much as they would have when the market was better. So for those people, I feel pretty bad. I think the advice I would give for most people right now is wait. We know this is cyclical. Last time this happened, I had 5 rentals, all financed the way I discussed, fully tapped out with cash and credit. So I was happy with my rentals, but I couldn't expand. And here I am looking at all these other people around me getting rich because people are giving houses away. All I got to do is clean up the yard because it hasn't been mowed in a while and clean up the interior. And I've got a rental house for $40,000, $50,000. Are you kidding? That's a free house. And I could do nothing. I'm bound and determined not to let that happen again. So the advice I say is save up a little cash, free up some credit, be ready to buy when it happens because it happens on a dime.
Man, that's super advice. And it's funny because it's so hard to do that with all of the hype. And when you see everyone else out there buying things and, social media just compounds it with everyone out there talking about all these amazing deals they're getting. It is so hard to do that, to just sit on it. I think a lot of people have trouble with it. And I think that's why a lot of people are doing what you're suggesting. They're overpaying right now. They're buying things they shouldn't be. I'm really concerned for some of the large multifamily commercial deals I see happening. I mean, some of these people are just going to get crushed when the cycle happens, and I feel bad for them.
Well, again, if you bought it right and it cash flows, you never have to sell. That's kind of the situation you want to be in.
Right.
So if I have to rent it for another 10 years and for the market to come back, or 5 years or whatever it is, that's fine. I'm positively cash flowing. Not a big deal. Give me a rental house with a positive cash flow. There's no reason not to continue doing that over and over and over as many times as you possibly can, as long as your cash flow remains positive. It's a happy day.
Right. A question that I've heard several times from people who are trying to take the advice of someone who tells them to save and wait for the correction is where to save the money. Where's a good place to save your money while you're waiting for this to happen? Do you have any thoughts on that?
Well, this is the part of the program where we say I'm not a financial planner. So no, I will not give that advice.
Gotcha. Smart answer.
Totally understand that answer. We don't expect someone who's not a CPA to give CPA advice. So we respect that. Thank you for clarifying that.
Absolutely.
I know you're not a lawyer, but when you talked about liability earlier, just to clarify, why is that important, and why should they have that mentality of protecting your liability?
Well, I think that there's nothing that can destroy your wealth than having a huge lawsuit against you. So I mentioned the little kid dying in a pool. I buy a house with a pool and I don't put a fence up there and I rent it. Their 2-year-old goes in and falls into the pool and dies. Obviously my fault. At least that's the way their lawyer will paint it. And now I'm looking at a $2-3 million judgment. Forget all the rent, all the rental houses I own. Those are all going to be stolen if I don't have protection. Plus, if I only have, let's just say I had $1 million in real estate, I lose all my real estate. So what about the second $1 million that I owe? The judgment against me. Everywhere I work, every job, every self-employed business that I start, they will garnish my earnings until that other $1 million is paid. So protection is important, but I think that a lot of people, especially real estate investors, get sucked into way too much. I have seen several people come into my office where they paid a lawyer $5,000 to set up all these LLCs, which flow into a master LLC, which then it's just way too much structure. It's very complicated. And here's an interesting thing. Let's just say that we're in California. California is a community property state. Husband and wife can own an LLC and elect to be a single member. And do we know why being a single member LLC is important?
Nope, because please educate us.
It keeps my fee to a minimum. If we have a multi-member LLC, like you and I own an LLC, we have a partnership return to file every year. That's another $600 and some to your CPA every year for filing the necessary tax forms. But if you have a single member LLC, which is really recommended for real estate, there's no tax return to file. It gets put on your personal return without paying your CPA an extra $600. It's a great savings. But here in Florida, We're a separate property state. So husband and wife cannot elect to be one member. So I have somebody, an out-of-state attorney, a Nevada attorney, who's formed all these LLCs for husband and wife, and they didn't realize they had to file tax returns on all of them. Now you're paying your CPA thousands of dollars just for your structure every year. It's excessive. It's unnecessary. You know, it would be great if the states would actually come up with the series LLC. You guys have heard that?
Right.
That would save thousands and thousands of dollars by all these real estate investors that want an LLC for every property. But they haven't done it yet.
Yeah, it's interesting. A lot of people don't even know why they have those entangled structures. They've just heard from people that's what they should do, or they've
Yes.
seen it done, and they do it. Yeah, that's interesting, and that's just another place where someone like you, I feel like, adds so much value. You know, by those little tidbits and things that most people just don't know. So I have a kind of an off the wall question for you. I'm just going to lob it out there. It's okay if you don't have much on this one, but
Okay.
I've just wondered quite a bit about what really wealthy people do for tax strategies that may be quite a bit different from what people, even people like us who are real estate investors and maybe a little more sophisticated than someone that doesn't even have investments. So the big, really wealthy people, do, just generally speaking, do they do things quite a bit differently than average guys like the three of us do? What is, any idea?
Well, I'll just mention a couple things. You know, when we were going through the last election cycle, there's a lot of talk about how Warren Buffett's secretary pays a higher tax rate than Warren Buffett. Why is that?
Right.
Pretty simple. Most of Warren Buffett's income is dividend and capital gains. So that's taxed at a maximum rate of 15% for most taxpayers. If you're in the highest tax bracket, that goes up to 20%. But 20% is still a great rate. That's a key way. And that's, you know, I do a presentation to a lot of real estate investors talking about the different tax rates of the real estate investor. We talk about a flipper, we talk about a landlord, and we talk about somebody who has capital gain income. And the rates of tax that they pay is vastly different. So structuring your earnings in a more friendly, tax-friendly way, totally legal, but it'll slash your tax bill in half. It's amazing. So the other thing we can talk about in the last election cycle, we talked about how Trump didn't pay any taxes. Adam, when you lose $98 billion on a real estate deal, I guarantee you will not pay any taxes. I will make sure of that.
That's excellent. I hope this happens to both of us in my lifetime.
But my primary base is the small business owner, the small real estate investor. So I let the bigger firms deal with the high end because they come up with certain strategies that lawyers and CPAs have gotten together, and they're iffy. Mm-hmm. They're disclosed transactions, which means that when you put them on your tax return, you have to disclose to the IRS we're taking a position that you may find contrary. Not a big fan of doing that because who wants to alert the IRS that, hey, audit me, we're taking a iffy position. So I let the bigger firms handle all that edgy stuff. I handle most of the deductions that we can take, accelerating depreciation, slowing it down, talking about retirement plans. Those are some of the best things for taxpayers in our arena.
That's awesome. Yeah, it's great.
That was a great question, Adam. I didn't even think of that. And I love that we talked about a variety of different strategies. So thanks for sharing that, Charles. And to recap, if you want to talk taxes or you want to learn more about it, just find an investor-friendly CPA because it's not worth you trying to learn it yourself. Is that a fair encapsulation of our conversation?
I think so. Absolutely. I think that the money spent on a good CPA that understands your investments and understands your strategies will more than pay for itself over time.
Fantastic. And if you don't get your taxes right, not only can it be a huge fine, it could cause massive headaches in your daily life. And speaking of headaches, we love to ask our guests some fun tech questions because we are the tech guys who invest. So what piece of technology is giving you the biggest headache today?
Well, today, nothing. But here are some things that have caused problems in the past that are really super annoying. Plug and play isn't. I don't know how I can hook all my printers to the network and how I can't see any of them. Or how everything's running just fine. Network's working, everything's working. Microsoft does an update, and suddenly I can't find the server anymore. All my files are missing. It's these little weird things that are so frustrating. And they're software only, and there's really no way anyone like I can ever figure it out. That's when I pick up and call the IT guy and say, help, I can't see any of my files. But plug and play should be just that. And so many times, it's not.
All right. That's great. That's great. All right, Charles, listen, it has been awesome having you on here. I think you've added tons of value to our listeners. And Charles, if someone wants to get a really awesome CPA who is an investor and can add tons of value to them, how do they get a hold of you?
Well, I'll give my email. It's charles@widgetcpa.com. That's WIDGET CPA.com. The phone number at the office is 727-953-9493. And I'd be happy to look over prior tax returns, see where we could have done things a little better, and see if the client sees value in that.
That's awesome. Yeah, thanks again. And for those of you listening outside of the Tampa area, Charles is in Clearwater, Florida. And Charles, do you work with out-of-state clients, people who aren't based here in Florida?
Yes, sir. I work with a lot of people in California, Nevada, New York, all over the continental U.S. And I do have some foreign investors where, say they live in Australia and they want to do some land investing here. They open up an LLC here. I can do that LLC tax return, and I can do their United States non-resident tax return as well. I don't do any Australia taxes or any other foreign country taxes, but I can absolutely handle their U.S. compliance.
Okay, excellent, because we have listeners from all over the United States, so that's good to know. All right, thanks again, Charles. We really appreciate you coming on the show and adding tons of value.
Fantastic. It was a good time, guys. Thanks. We'll talk soon.
Thanks, Charles.
Bye, Kevin.